Hello and welcome back. Thank you for tuning in. If you subscribe to my Substack, you already know that Jerome Powell, in a very casual manner, said something extremely important during the hearing in Congress this past week. It was a sugar-coated warning of a looming banking crisis. This is something that I've been doing my very best to bring to your attention for a very long time now, as you know, for months. And now that the Federal Reserve Chair said it himself, it is truly only a matter of time until we see it unfold. It could be a matter of days, and I will tell you why in a second. I won't play the video right now, but you're welcome to watch it over on my Substack in my weekly recap post that I will link in the description below. Effectively, Jerome Powell said, and I quote here, "Sure, there will be bank failures, but this is not the big banks," he said, so you should not be worried. He expects to see bank failures very soon. He added that big banks will be just fine. It is small to mid-sized banks that should be concerned. He said it is manageable, although I can guarantee that nobody knows what that means in the context of banking turmoil. What exactly is manageable? Was the Silicon Valley Bank bail-in or bail-out, however you want to refer to the Fed's decision to help private investors recover their funds last year, was that manageable? And if it was, according to Jerome Powell, then it is safe to say we're in deep trouble. With that being said, I have 4 words for you today. Expect more banking turmoil. It is inevitable. As the result of this bank turmoil that will impact small to mid-sized banks, we will see more consolidations. And my prediction is that we will see it by the end of this year. Why exactly does Fed Chair Jerome Powell say that small and mid-sized banks are in trouble? And more importantly, is it all by design? Is it intentional? Let's dive a little bit deeper, shall we? The first thing to note here is that the Federal Reserve is going to back off from its plan to require banks to hold higher levels of bank capital, which was the requirement, of course, implemented following Silicon Valley Bank collapse last year. Higher levels of bank capital effectively ensure that banks have more liquidity to potentially deal with bank runs. Now, the Fed knows that due to extremely high exposure to commercial real estate portfolios that are losing value as we speak, banks are going to have a really difficult time dealing with billions of dollars in loans that are due for refinancing this year. Yet, the Fed says, don't worry about it. You don't need more cash to cover those bad loans. We will just fold you into a bigger bank and your customers won't even notice, or as an alternative, taxpayers will be forced to bail out those depositors of failed banks. Those are the 2 likely outcomes. Jerome Powell's comments highlight looming liquidity challenges for smaller and mid-sized banks. On March the 11th, the Federal Reserve will hold its support through the Bank Term Funding Program. There is a very good chance that it may trigger a ripple effect across the banking industry, especially as there is so much instability and this growing sense of stress that consumers are facing as they're taking on more and more debt. This crisis has the potential to have a massive ripple effect across global economy too, primarily because the United States dollar is the global reserve currency. If you're not familiar with how the Bank Term Funding Program works and why it's been keeping many banks open for the past year, really quickly I would like to explain. This program was established following the banking crisis of early 2023. The program was initiated by the Federal Reserve and it offers loans of up to 1 year in length to banks, credit unions, and other depository institutions that want to pledge U.S. Treasuries, agency debt, and mortgage-backed securities, as well as other qualifying assets as collateral for these loans. And here's the catch. These assets are valued at par in order to give out these loans. While the market value of these assets is in red, it is negative. It cannot be sold without taking massive, truly massive losses, which is why these banks would rather hold on to their devalued assets, keep them on their books, hoping for lower rates in the near future, and then use those assets to get loans from the Fed. And so the Fed is valuing these assets at par, not their decreased market value, to prop up these banks. This is how many smaller banks manage to stay open this long. Once this program expires, however, and the Federal Reserve keeps interest rates higher until at least June of this year, there is a very good chance that regional banks and community banks will start having major troubles maintaining liquidity, partially because they hold truly massive amounts of commercial real estate debt. I have several videos where I explain this in further details. I won't repeat it today, but I will link those videos for you in the description below. There's a very good reason why foreign central banks have been stockpiling gold. This is all related. Gold has just hit a new record high, driven by central bank demand, not by investors' demand. It's the central banks that are getting rid of their foreign currency exchange reserves denominated in dollars and buying more and more gold. Everyone is looking for safe haven assets. Gold and Bitcoin, both of which are considered hedges against systemic risk, have reached record levels as the result. And so as central banks stockpile gold at absolutely unprecedented rates, it has become absolutely clear that they anticipate the decline of the United States dollar, which will inevitably be accompanied by a banking crisis. As you can see, America's banking system will likely continue to become more and more dysfunctional, with orchestrated banking crises being very likely possibilities in the near future. Thank you for watching. I hope that this video was helpful, and I hope that it encouraged you to do your research, to reach out to your banking institutions, to reach out to your credit unions and ask them these questions. Please show your support. It does go a long way. Give this video a thumbs up. Consider sharing it, and make sure that you are subscribed both on Rumble and YouTube. Please make sure that you are subscribed on Rumble. It is a great backup channel. I would love to have you back for my next one tomorrow. And if you enjoy reading, make sure that you follow me on Substack. Have a great rest of your day, and I will see you tomorrow. Bye for now.